Sometimes, to predict the future, you only have to look at the past. Because of what happened in the car market 16 years ago is happening again today, but far worse. The 60-day past delinquency rate is now higher than it was back in 2008.
Subprime auto delinquencies are actually worse now than they were during the Great Recession. And I think that speaks to the impact of higher prices.
The number of cars referred to you by the banks to get repossessed has tripled?
Correct.
Not having a means of transportation can be devastating to a household. Because if you don't have a car, you can't get to work. If you can't get to work, you can't buy food, pay bills, or pay for rent. So in this video, I'm going to dive into what led to the crisis, and by looking at the past, how is this going to play out in the real estate market? This repo crisis is not a problem that is solely in the automotive industry. It is a sign of an underlying problem. The easiest way to understand this problem is by using Abraham Maslow's hierarchy of needs. For those of you who are not familiar, these are the categories of human needs. Humans fulfill these needs according to their priority, the bottom being the most important to survive. A vehicle falls under the basic needs category. A vehicle can keep you dry when it rains, warm when it snows, or cool when it's too hot to travel. It can also get you to your destination faster and safer. But vehicles are also a status symbol. When a vehicle is used as a luxury item, it now falls under the psychological needs category. When you drive that fancy sports car, you're going to turn some heads when you pass by. You get that sense of accomplishment and that hit of dopamine. But at what cost? Back in December of 2021, interest rates on the 60-month auto loans dropped to 3.85%. During that time, people were already in a financial euphoria. So they went and bought cars over MSRP, with zero money down and even financing the dealership fees. To top it all off, lenders loosened their lending criteria. Alright, let's recap. So people paid more than the value of the vehicle, borrowed more than the value, and banks gave loans to less qualified borrowers. If these 3 points sounded familiar, that's because all of these were factors that caused the great financial crisis 16 years ago. Now, if you think that's bad, nah, it's only going to get worse. Because when you have a market that is willing to pay ridiculous prices for cars, what is stopping the manufacturers from making a more expensive version of the vehicle? According to Kelley Blue Book, the average new car price is $49,000. I first thought, this must be at least an Acura or Lexus, right? So I did a little bit of research, and what I found was ridiculous.
I don't know if you can read this or not, but then Shelby adds all of this stuff on it for a total MSRP of $141,430. This black Ram truck behind me is $103,280. This 2024 Sienna Platinum Hybrid, let's look at the window sticker, is $55,660 plus $3,000 in junk that you don't need.
To put that into perspective, a 2024 Toyota minivan costs just as much as a 2020 Mercedes-Benz C-Class. Wages haven't grown fast enough that a vehicle in the general segment would be priced similar to a luxury sedan in just 4 years. According to Experian, these are the average car payments for new and used cars by credit score. Notice that even with an excellent credit, you'll still be paying $700 per month. Head over to TikTok and you won't run out of examples of real-life people paying $700 and even up to $1,000 per month in car payments. And that's just car payments. There are other costs of ownership, but the biggest one is insurance. If you just had your insurance renewed, you might notice that it has jumped significantly. These are the states with the highest insurance cost. They are at least $200 per month. According to the Bureau of Labor and Statistics, insurance jumped 20.3% from last year, and it's the highest since 1976. So let's circle back on the monthly car payments. Then add on top of that the average cost for insurance, then gas, of course. We have now come to the point owning a car is equivalent to paying rent. It's kind of like paying rent twice in the same month. It's unsustainable, especially when other costs like food are still at an all-time high. Which brings us to this point where Americans are now defaulting on their car payment. So I want to credit these two YouTube videos for bringing this up. The search term "give back car" has been slowly increasing. This spike is from November 2023. Notice that in July of 2008, it spiked as well. This chart illustrates the 60 days past due delinquency rates. Notice we exceeded the numbers posted back in 2008. That's because the US auto loan debt has grown substantially over the years to the amount of $1.6 trillion. So it's time to answer the question, how does the automotive industry affect the housing industry? Have a look at this chart. Notice the pattern of the three major spends for consumers. During the times of financial euphoria, credit cards and auto loans are identical. Housing is a lagging indicator of distress because people would give up other expenses before they would give up their shelter.
Have you had to choose between car payments and other bills?
Absolutely. I've had to choose to have my rent late.
See, this channel is real estate and financial related, but for the real estate investors watching, these are things we need to pay attention to because the consumers, aka the renters, have other costs that are eating to their income as well. Not keeping a pulse on what is going on with everyday consumer could be the answer why tenants are late paying rent, or a property staying vacant for a long time because the asking rent is way too high. No one can say for certain what the future will look like, but if in the next couple of months, the pattern still continues to what it looks like 16 years ago, then we be seeing history repeating itself. Outside of historical data, we as humans have this gift to put ourselves in someone else's shoes. We may not be part of the statistic, but we can ask ourselves, what would I do if I was in that situation? If people are drowning in credit card debt and not able to pay their auto loan, then what about the single largest cost of a household? So watch this video next to find out how decreasing rents will affect the real estate market.